Welcome back. We are dealing with Chapter 17 on earnings per share. So our study objectives or learning objectives for this chapter include understanding why earnings per share is important, understanding how to calculate it, when it should be presented. It usually shows up in the income statement, so right down at the bottom, and so we'll get into the details of that. We'll talk about the calculating earnings per share in a simple capital structure. Then we'll expand it to consider a more complex capital structure. So cases where we might have derivative securities and convertible securities, those sorts of things. The kinds of hybrid and complex securities we talked about in Chapter 16, for example. And then we'll talk about some analysis that can be done with earnings per share and how we connect earnings per share to market values as well as accounting values. Then we'll talk a little bit about the differences between public and private GAAP and what changes are in the pipes as it stands. So this chapter examines the issues related to earnings per share. The significance attached to the earnings per share figure by shareholders and potential investors has caused the accounting profession to direct a great deal of attention to the calculation and presentation of earnings per share. So the information is used in evaluating a company's profitability and its value. Other than non-public companies, most companies are required to report earnings per share information on the face of the income statement. And so because of its importance, earnings per share must be reported. Due to its importance, earnings per share is a prominent measure of the profitability of a company. So it needs to be shown as part of the financial statements. It's calculated on the basis of some of the numbers in the income statement, so that seems to be a good place to put it. ASPE doesn't require earnings per share calculations in the financial statements because the cost-benefit trade-off for private organizations is not as significant as it is for public companies, where the readers and investors reading the financial statements don't have that private information that most managers of private organizations would have. Because private enterprises are generally quite closely held, and so they have much more information about the detailed operations of the business than investors would have in publicly listed corporations. So when the income statement contains lots of components of income, the earnings per share number related to those other components may be required to be disclosed. So we actually break it up into some subcategories. So that allows financial statement users to recognize the effect of the income from continuing operations, which they can expect to hold for the next year, separated from income or loss from other items such as discontinued operations or sometimes unusual items. Or we used to separate earnings per share for extraordinary items. That's no longer a category that's valid under international financial reporting standards, so it's not required any longer. But IFRS does require earnings per share has to be shown for all of the periods presented, and any prior period earnings per share needs to be restated for any stock dividends and stock splits which have happened since then, so that it's based on the current existing number of stocks outstanding. So one of the issues is there are a number of ways in which common shares could be issued, so we find it important to identify potential common shares. So if the capital structure of a company consists only of common shares or has no potentially dilutive convertible securities or options or warrants or anything else that could increase the number of common shares so that we're spreading apart the earnings available to common shares among a larger group of shareholders, then we wouldn't disclose the fully diluted earnings per share. But when that is the case, we need to calculate the minimum amount that could be attributable if all of the dilutive securities were actually exercised. So if there are no such shares or such potentially dilutive securities, we call that a simple capital structure. If there are potentially dilutive securities, then we call that a complex capital structure for the purposes of the earnings per share. So in general, earnings per share is calculated based on net income available to shareholders. So earnings per share tells the users of the financial statements, the common shareholders in particular, how much of the available income is associated with the shares that they own. So their share of the income, earnings available to common, and they know how many shares they have relative to everyone else. So it helps common shareholders find out about their future dividend payout entitlements, the value of their shares, because it's established, often price earnings ratios establish a price based on earnings per share, and the impact of any other potentially dilutive securities. So income available to common shareholders is usually calculated as net income minus preferred dividends. So preferred dividends, of course, get paid before common shareholders get any dividends. So that entitlement has to be paid out before the common shareholders' income available. And then we divide that by the weighted average number of common shares. So if there are new shares issued during the year, that will increase the weighted average number of common shares. But if they haven't been outstanding for the whole year, then the capital that's provided by the issue of those shares is not available to management to earn income during that period. So we take the income available to common shares minus any preferred dividend entitlements, divide that by the weighted average number of common shares outstanding during the year. There's a basic form. So we take actual earnings and actual number of issued shares and calculate the earnings per share available for each individual common share. And then we also calculate diluted earnings per share in the case of a complex capital structure. So basically we're saying, what if all those potentially dilutive securities were issued, what's the minimum that I can lay claim to as a common shareholder? So if all of the financial instruments that could be converted were actually converted, how much does that leave me with? As we said, under IFRS, EPS has to be reported on the income statement, and ASPE doesn't require it. Okay. If you report diluted earnings per share data for one of the periods that you're showing, then you have to report all of the other ones as well. So it would be just the same as the basic earnings per share if there was no dilutive effects at the time. So you would just show them separately, but you would have to do that if you show any diluted earnings per share. All of them have to be disclosed, even if they're the same as the basic number. And when we restate the operations of a prior period, earnings per share should be restated as well, because it reflects basically the trend or the trajectory of share values over time. So if you restate, of course, you have to disclose the fact that you've done a restatement and the effect on the current year as well. So on the income statement, how do we actually present it? Well, we show earnings per share in major categories. So we show the amount of income from continuing operations divided by the weighted average number of shares. Then we, if there are any discontinued operations, any gain or loss in earnings from those discontinued operations would be shown as well, so that you would come up with a total number at the bottom for the total net income earnings per share. In a complex capital structure, you would show both the basic earnings per share and the diluted earnings per share. And so here we have to talk about the idea of potential common shares and what the maximum number of common shares could be given the complex capital structure, so that we might have to share our earnings with a bunch of other people. What's the minimum that we can lay title to? That's what diluted earnings per share shows us. So if we have that case, we have the basic earnings per share before discontinued operations with this, we show the discontinued operations separately because, again, it's a permanent income before discontinued operations is a permanent effect. Discontinued operations would be a transient effect, or a transitory or temporary effect. And so net income is the combined effect of both of them. In the example we see here, the diluted earnings per share has the same categories: before and after, before discontinued operations, and then after discontinued operations. And so we show essentially 6 categories of earnings per share calculations. Okay, let's take a moment to kind of define some of the key things, key concepts that we need to think about. When we're talking about complex capital structure, we're talking about potential common shares. So it's any type of security that might entitle its holder to one or more common shares during or after the end of the reporting period. So for example, if we don't pay out dividends this period, and the value of retained earnings carries over to the next period, and a potential common share is issued or is exercised so that it exists, then we're splitting this period's income over more shares, and that means that we don't have as high an entitlement to earnings as we would if there were no potential common shares. If you have a company without any of those potentially dilutive securities, you would just present the basic earnings per share, and complex capital structures are required to calculate and present both, so you know what is entitled under the existing capital structure, and you know what you're entitled to under the potential thinner spread required by dilutive securities. If preferred shares are cumulative and the dividend is not declared in the current year, then next year's income available to common shareholders would be deducted for the entire amount in arrears, because they have to be paid before you can get any of the income. So any amount equal to the dividend that should have been declared for the current year would be subtracted from net income or added to a net loss to increase the size of the net loss if it applied. Weighted average common shares includes all of the shares issued or purchased during the period, weighted by the fraction of the period during which they're outstanding. So if it's half a year, they only get half the weight as those shares which have been outstanding for the entire period. So that weighting is an important part of the calculation. Stock dividends and splits and reverse splits, we've talked about these a little bit in a prior chapter, but when these happen, the calculation of the weighted average number of shares is essentially carried back to the beginning of the earnings per share disclosed in the income statement for this period. And that's because we need to determine the effect of the trend, right? So we need to be able to determine whether earnings per share is going up substantially from prior periods, and so we need to keep a common base in terms of the number of shares that are outstanding that are used to calculate the earnings per share amount. If a stock dividend or stock split occurs after the end of the year but before the financial statements are issued, then the weighted average number of shares outstanding for this year and any other years must be restated for the effect, so that when the investors are reading the financial statements, they will have the right base for their calculation. Mandatorily convertible instruments, where common shares would be issued in future due to mandatory conversion of a financial instrument that's already outstanding, then it's assumed that the conversion has already taken place for earnings per share calculations. So if it's required by the terms of the contract that it will be converted at some time in the future, then we would dilute the amount of earnings per share in the calculation we already do. Contingently issuable shares are shares that are issuable for either a small consideration once a condition related to uncertainty has been resolved. So whenever you see the term contingent, you're referring to some kind of uncertainty. When that condition has been resolved, then there may be a small fee, but essentially it increases the number of shares outstanding. If those shares are issuable simply with the passage of time, which is essentially the case with the mandatorily convertible financial instruments we just talked about, they're not considered contingently issuable, since it's certain that they will be issued, because it is certain that time will pass. So there's no additional action that has to be performed. There's no exercise required. When time passes, those shares will be issued, and therefore the earnings per share would be adjusted. So when they are issuable based on something else, such as profit levels or performance targets, then there is some uncertainty, and so they would be included in the calculation of the basic earnings per share only when the conditions are satisfied. If the only condition is the passage of time, for example, employee stock options, which are issued just because you've spent the year working for the company, those would be issued simply with the passage of time, whereas management stock options based on profit target would not be mandatorily issued. So in my example, ESOPs, employee stock option plans, would be included in the basic earnings per share calculation, whereas management stock option plans would not be, because they're incentive or compensation based. Now, computing earnings per share. The computation of earnings per share, we take the earnings available to common shares and divide by the weighted average common shares outstanding during the period. So that constitutes the two key calculations we need to do for earnings per share. And so when we're computing the weighted average number of shares outstanding, any shares issued or retired during the period are weighted by the fraction of the period during which they were outstanding. So we add those up, and those amounts are added to the number of shares outstanding for the entire period, and that tells us what the weighted average number of shares is. Any stock dividend or stock splits that occur during the period would require restatement of the previous numbers, if you hadn't picked that up already. Okay, so if the capital structure is simple, it only has common shares and preferred shares, then we would only use basic earnings per share. If there are convertible preferred shares or convertible debt, then usually those are convertible into common shares. So if it's convertible into something else, so if it's convertible debt convertible into preferred shares, then that wouldn't cause a dilutive effect. Whereas if it's convertible into common shares, it would. Any options or warrants, you need to consider whether they're potentially dilutive as well. There's a premium that would be paid. If the company has issued, say, a call option, actually, we'll talk about options in a bit, but I don't think the example I was coming up with would actually work. So if the company has given itself the obligation to issue more shares, which would usually be the case when they're obligated to sell at a certain price, so that would be a put option rather than a call option. Warrants that have the put characteristics as well, the right to sell at a certain price. So if they'd written a put option and given someone else the option to require them to issue shares at a certain price, then those shares would increase the number of potential common shares available, and the earnings capacity would grow by the amount of the premium and the amount that was received for the exercise of the option or warrant. Any other contingently issuable common shares, so stock option plans that we mentioned before, or anything else that would potentially increase the number of common shareholders sharing in the earnings per share. And the idea here is that common shareholders have the last interest in the company's income. They're the residual interest. So after everybody else is paid, we pay financing costs, including interest. All of the operating expenses get paid first, and then after that, we're required to pay preferred share dividends their share, and then whatever's left over is available to common shareholders. So it's the residual amount after everything else is paid. So income available to common shareholders is net income minus the preferred share dividends, interest expenses already deducted in arriving at net income. In a simple capital structure then, in a simple capital structure, we just calculate basic earnings per share. We take the net income and divide by the weighted average number of shares outstanding. If there are discontinued operations, then we would show those separately from the continuing operations as well. Okay, so if the preferred shares are non-cumulative, we would deduct only declared dividends for this period, because in future periods there's no restriction on the amount of common share dividends that we could pay except for that year's cumulative, or that year's preferred dividends. If the preferred dividends are cumulative, then we would deduct declared dividends and we would still deduct only 1 year's dividends if they're cumulative, whether or not they were declared. So if there were no dividends declared, then this year's income is still, we're still on the hook for the preferred dividends. So the amount of this period's income is held in arrears for the payment of preferred shares in the future. So even if we don't declare dividends this period, the entitlement to preferred shares would be deducted in the case of a simple capital structure calculation. So when a company has both preferred and common equity instruments outstanding, the preferred dividends for the current year are subtracted from net income to arrive at income available to common shareholders. If dividends and preferred shares are declared and a net loss occurs, the preferred dividend is added to the net loss for purposes of computing the loss per share. So it increases the amount of the net loss. Okay, which we just said. And preferred shares should be subtracted from income from continuing operations. So they're deducted from the top. They don't affect the amount of discontinued operations because those discontinued operations are no longer relevant after this period. So we would deduct the dividends declared on preferred shares from the continuing operations income and then from net income at the bottom. They should not be deducted in calculating earnings per share from discontinued operations. So here's an example. Michael Limited has a net income of $3 million. They have 100,000 Class A preferred shares, which are cumulative, and 100,000 Class B preferred shares, which are non-cumulative. The dividend amount of the Class A shares is $4 per share. Dividend amount for B shares are $3 per share. They didn't declare any dividends or pay any dividends in the current year, so we need to calculate income available to common shareholders. So we take the net income of $3 million. We subtract the amount attributable to Class A, which is the, let's go back here. The cumulative shares are A, B is non-cumulative. So A, cumulative shares, even though we didn't declare them, we need to deduct in this period because they're kind of attached to this net income. So that gives us $2.6 million that is remaining for the common shareholders. There are no dividends declared on Class B, and since it's non-cumulative, we only show the declared. So the income available to common shareholders is just the $2.6 million. Weighted average number of shares. So the weighted average number of shares is weighted by the period of time they're outstanding. So you would need to calculate in terms of months or portion of the year that's outstanding. So each transaction needs to be analyzed. If shares are issued, if they're reacquired, if they're retired, each of those separate transactions need to be calculated and weighted in determining the final weighted average number. So the example we have here, we have a beginning balance of 90,000. That's outstanding for the entire year. 30,000 shares are issued in April. So that's after January, February, March. That's after 1/4 of the year has gone by. July 1st is after half of the year. Another 39,000 shares are purchased. So they're purchased back. That would reduce the number of shares outstanding. November the 1st, which is after 3/4 of the year, 60,000 new shares are issued then. And our year-end balance is 141,000. Okay, does the math actually work? 120. So this is the running balance that we show here. So start with 90, we add 30, we subtract 39, that gives us 81. We add 60, that gives us 141, and that holds through to the end of the year. So in calculating the weighted average, we calculate the fraction of the year which that number of shares was outstanding. So between January 1st and March 31st, if we take that first quarter of the year, 90,000 were outstanding. The weighted average number of shares is 22,500. The level moved up to on April 1st to 120,000 and stayed there for another quarter of the year. So 120,000 times a quarter is 30,000 more. Then it moved down to 81,000, and 81,000 what was outstanding from July 1st to Halloween. 81,000 times 4/12, so that's 4 months. January starts well, it's June. June is the 6th month, so that's the end of 6 months. October 31st is the 10th month, so 10 minus 6 is 4. 4 months out of 12, which means 27,000 is the weighted amount. And November 1st to December 31st, there was 141,000 outstanding for those 2 months. So the total weighted average shares outstanding is 103,000. You could also do the calculation by taking 90,000 for the full year, and then the 30,000 for 3/4 of the year, and then the next reduction for all but the last 6 months of the year, and then the 141,000 for the last 2 months of the year, you'd end up with the same amount, algebraically identical. Okay, so stock splits, stock dividends are a change in the number of shares with the same income being generated. So we record stock splits and stock dividends and the effect of them on the weighted average number of shares, and then we would restate them backwards. So whenever we have a stock split, all of the previous numbers are actually adjusted for that. So it would be weighted as if they were outstanding in that proportion even earlier. So we would restate the weighted average number of shares outstanding from the beginning of the year. So there's no change in the assets or in the shareholders' total investment. The only thing that's happening is the number of shares is changing. So by restating that number, we make sure that we can actually compare the earnings per share this year to prior periods. And as we discussed before, if there's a stock split or stock dividend after the year end but before publication, we would restate the earnings per share because it affects the weighted average number of shares outstanding at the time when the financial statements are being read. So it applies to the current year and all previous years if we issue comparative statements. And of course, we usually do see those as part of annual reports. So again, a simple capital structure example. We had 100,000 shares outstanding. We issued another 20, then issued a 50% stock dividend. So there were 120 outstanding before. A 50% stock dividend adds another 60. And then November 1st, we added another 30. So the ending balance is 120 plus 60, 180, plus 30 is 210. So the new calculation would take the 100,000 and the 120, which happened before the stock dividend of 50%. We would multiply them by 1.5 because each of them is greater by that amount after the stock dividend. The 180,000 and the 210,000 already included the stock split or the stock dividend, so we don't gross them up by the 1.5. And the fractions of the year outstanding are consistent with the time frames. So January, February is 2/12, March, April, May 3/12, June, July, August, November, June, July, August, September, October. There we go. June, July, August, September, October, 5 months, and then November and December, 2 months. All right. Now, complex capital structure. So whenever there are dilutive securities such as convertible securities, options, warrants, other rights of claim on common shares, when anything that when converted could dilute the earnings per share among a larger number of common shareholders for the same investment amount. So dilution is the reduction in earnings per share, which would happen if those potential common shares were actually issued. Then if those securities were issued, it would reduce the amount of earnings per share. If shares are anti-dilutive, so if they were converted, they would actually increase earnings per share, then we wouldn't include those. So any anti-dilutive effects would not be reported because basic earnings per share already is set at that level. It wouldn't make any sense to describe a dilutive situation which was more than the basic earnings per share. So if we have a complex capital structure, we have to show basic and fully diluted earnings per share. And the purpose of reporting the diluted earnings per share is to disclose the maximum possible reduction in earnings per share that could take place if all the qualifying issuable common shares were in fact issued. So this calculation requires the determination of the weighted average number of common shares issuable and the income effect of various issuance possibilities. So if your new securities show up at the beginning of the period, that's a lot higher weighted average number of common shares, but it also provides us with the ability to earn additional income on the proceeds for a longer period of time as well. So there's a sort of this notional income effect that we have to include as well. So all dilutive securities must be considered kind of in order of their dilutive effect. And so when we are determining whether or not diluted earnings per share should be reported, all of them need to be considered. So you can't just consider some of them, you need to consider the entire list, which can take a while sometimes if there's a lot of them. The method used to measure the dilutive effects of a potential conversion is called the if converted method. So if it was converted, what would be the sort of the worst case scenario? So the if converted method assumes that the conversion of the convertible securities happens at the beginning of the period, and we eliminate the consideration of interest net of tax. So basically, if we have debt which is convertible, then the interest payment to the debt would no longer be required because we've converted the debt into convertible securities into common shares. So the denominator